Over the last year, the global car market has quietly entered a state of emergency. Toyota, Volkswagen, General Motors, Ford, Nissan, and Volvo have all watched their profits plummet. And frankly, they were the lucky ones. Honda recently posted its first annual loss in nearly 70 years. Not to be outdone, Stellantis recorded the largest financial loss of any automaker outside of a major global recession. Even at the ultra-luxury end of the spectrum, Porsche and Jaguar Land Rover saw profits plunge by a staggering 99%, while Ferrari shares slid 30% in just 6 months. For the past century, the automotive sector, alongside the construction industry, has acted as the ultimate canary in the coal mine for the wider economy. When it's healthy, it anchors a nation's industrial base with good-paying jobs. When consumers are buying, it's a sign they feel confident enough to take on long-term financial commitments. On the surface, 2025 looked like a massive victory. Global car sales fully recovered to pre-pandemic volumes, and because the average price of a new car skyrocketed, total industry revenue has never been higher. But this brings us to a glaring paradox. How are global car companies bleeding cash during what should be a gold rush sales year? If automakers are crumbling right now, what happens when the market inevitably cools off? The answer lies in 4 massive systemic problems happening behind the scenes. The first and most immediate crisis is what we can call the Great EV Flip-Flop. If you examine the financial wreckage of almost every major legacy automaker, they all point to the exact same culprit: billions of dollars poured into electric vehicles that they can no longer sell. Consider the numbers. Honda's historic loss was driven entirely by billions spent tooling up for an EV lineup that consumers aren't buying. Stellantis took a massive $26 billion hit, with $25 billion of that consisting of direct write-downs as they quietly abandoned their aggressive EV targets. Ford admitted its electric division lost nearly $5 billion in a single year, while General Motors quietly scrapped its pledge to go all-electric by 2035, writing off nearly $9 billion in investments. For the last decade, legacy car companies were caught in a frantic game of catch-up. Pressured by Wall Street investors who wanted to see tech company valuations, every legacy brand raced to build an EV portfolio. But they misjudged the market. The early adopters who actively wanted an electric vehicle have already bought one. Now that the market is flooded with competing models, it isn't attracting mainstream buyers, it's just slicing up the exact same pool of original customers into smaller, less profitable fractions. In fact, research from Cox Automotive reveals that a growing number of current EV owners are actually looking to switch back to internal combustion engines or hybrids. Because of this, automakers are currently rushing to rewrite their balance sheets. A factory designed to build 1 million electric trucks a year is worth a fraction of that value when it's only producing 10,000. Brands are taking these multi-billion-dollar losses all at once, acting like a herd of zebras crossing a river filled with crocodiles. They hope that if they all book their massive losses at the exact same time, angry shareholders won't single out any individual company. But these write-downs represent real, vanished capital. And running dual development tracks for entirely separate gas and electric platforms is actively burning holes through corporate cash reserves. The second threat is a silent killer: the rapid erosion of badge engineering and brand identity. Historically, luxury and performance cars have been gold mines. They don't actually cost radically more to manufacture than standard mass-market cars, meaning the astronomical markups are pure profit driven entirely by the prestige of the badge. Porsche has enjoyed comfortable 19% operating margins, while Ferrari regularly commands unit margins of over 50%, netting $250,000 in pure profit on a single vehicle. Consumers were happy to pay 8 times the price of a regular commuter car because high-end engineering gave them an exclusive performance edge. Today, that edge has been completely democratized. Modern engineering has made almost every new car incredibly fast, and performance EVs have effectively identical spec sheets. Whether you are looking at a traditional luxury badge or a mass-market alternative, they nearly all promise 1,000 horsepower, a 0 to 60 sprint in 2.5 seconds, and a 100 kilowatt-hour battery. When a base model EV from a mass-market brand can match the straight-line performance of a $500,000 exotic car, selling a vehicle based on engineering prestige becomes a very tough sell. This commoditization is happening all the way down the ladder. To the average consumer, modern cars are starting to look and feel like household appliances. Almost every mid-tier sedan or SUV now features efficient turbocharged engines, Apple CarPlay, 5-star safety ratings, and premium-feeling cabins. Because automakers increasingly rely on the exact same third-party suppliers for their electronics, brakes, and safety systems, the car market is beginning to mirror the laptop market. Just as consumers care more about processor specs than whether a laptop is an HP or an Acer, car buyers are losing their brand loyalty. They simply want the best features for the lowest monthly payment. This appliance-like shift leads directly into the third problem, the rise of Chinese automakers. While trade barriers and strict tariffs keep the domestic American market relatively insulated, European and Japanese automakers rely heavily on global exports to survive. For decades, their most lucrative growth market was China, where a rising middle class enthusiastically bought Western luxury cars as status symbols. That golden era is officially over. Domestically produced Chinese vehicles have evolved at an unbelievable pace. Xiaomi, a consumer electronics giant that didn't even have an automotive division 5 years ago, delivered over 400,000 vehicles in its first full year of production, with its base model directly outselling the Tesla Model 3 in China. Backed by rising domestic pride, Chinese consumers are actively abandoning Western legacy brands. Worse for legacy brands, China's massive manufacturing apparatus is expanding outward. China exported over 1 million vehicles to the European Union recently, capturing roughly 7% of the market, with export volumes accelerating by over 60% year over year. Baidu alone captured roughly 20% of the entire global EV market. The final and perhaps most dangerous structural threat is the looming wall of consumer debt. The average price of a new vehicle in America has climbed from $38,000 in 2019 to nearly $49,000 today. Simultaneously, the wave of cheap, zero-interest car loans written during the pandemic era is coming to an end. As everyday consumers return to dealerships to trade in their vehicles, they are walking into a trap: drastically higher interest rates stacked on top of an inflated base vehicle price. The average monthly car payment has climbed to an unprecedented $773, and an astonishing 20% of all new buyers are signing up for monthly payments of $1,000 or more. Because modern vehicles are built better and last longer, financially strained households are realizing the smartest move is to simply drop out of the upgrade cycle entirely. They are holding on to their current cars longer because trading up means paying double the interest for features that have largely plateaued. This consumer debt crunch creates a double-edged sword because high interest rates are mauling the automakers just as badly as their customers. Manufacturing cars is an incredibly capital-intensive business, and legacy giants carry massive amounts of corporate debt to fund their factories and lending arms. Ford, for example, sits on over $160 billion of total debt. The rising interest payments alone on that corporate debt are now consuming up to half of their entire free cash flow. When you piece all these factors together, it becomes clear that the global auto industry isn't just experiencing a bad quarter, it is facing a structural reckoning. Automakers are burning through billions of dollars in cash on technology bets that the mainstream public doesn't want, creating highly advanced products that everyday families can no longer afford, all while facing a hyper-efficient wave of global competition that threatens to commoditize their century-old brands. It is a perfect storm, and the industry's golden era of easy margins and blind brand loyalty is officially drawing to a close.